Good day, everybody. Today I'm here, we're going to talk around fixed income and what a big difference 2 weeks really does make in the world. If you listen to an earlier presentation in January that I did, I said it's all about the Fed this year. Can you believe how the world has changed within 2 to 3 weeks, and that the geopolitical events in Eastern Europe is actually overriding the biggest central bank in the world at the moment. Yes, the Fed is still going to hike rates, but we have clearly seen over the last 2 to 3 weeks that the market was expecting the Fed to hike about 7 times this year to around 1.5%. It's clearly been tapered back, and the market now says, well, the Fed will probably not hike by 50 basis points at the March meeting anymore, probably 25 basis points, and they'll probably hike 4 to 5 times this year. Very, very different interest rate profile out of the dollar market. If we think about the other central banks, we know that the Bank of England is very hawkish, but maybe they'll go a little bit slower as well. The ECB was expected to hike somewhere in 2022. Maybe with what's happening in Eastern Europe, the ECB will probably also not have to hike rates in 2022. Can you believe it? So what has really changed is geopolitical risk. So at the end of February, beginning of March, we've obviously had this whole situation around the Ukraine, and it has affected markets. Why? Why is it important? So we look at an index called the MOVE Index. What is the MOVE Index? It's an index that tracks the volatility of US bonds, or US treasuries as it's called. And as risks in the world rises, this MOVE Index goes up and the bond market gets worried. Think about it. When we stood up in the beginning of the year, we said US treasuries are probably going to be well above 2%. They've rallied hard. They're probably at 1.7%, saying to us, there's a lot more risk in the world. There's a flight to safe havens. Bonds is going to be the place for safe havens. And we've seen a big move back into the dollar and back into US treasuries. Are we then surprised that bonds rally, especially developed market bonds? That's not always true for all bonds in the world, and we'll look at the different sectors in bonds. So right, developed market bonds. So we said interest rates are going to go up. The central banks in the world is going to hike rates. Now we say, woo, they're going to hike rates, but it's probably going to be at a slower pace, less rate hikes. Bonds are not going to go as high as we initially thought because of so many uncertainties. What does this geopolitical risk actually mean for bond markets? So what's been happening in developed market bonds? So we said earlier in the year, central banks are going to hike rates, nominal bond rates are going to rise. That US Treasury will probably go to around 2.5%. Now we're saying, whoa, central banks are going to hike rates slower. Those bond yields may not go as high as 2.5%. In fact, they're well below 2% at the moment. The German 10-year bond, remember it was at minus 50 basis points. It went probably to around plus 30 basis points. And now it's back around minus 10 or 20 basis points again, telling you bond markets in developed markets are very worried around what's going to happen in Eastern Europe. So bond markets very aware of what's going to happen in Russia, and they're pricing for risk. Remember, there's a big risk that Russia can default on its bonds. Why? Because of the exclusion out of the SWIFT system. Now, if we move to emerging markets ourselves, we can obviously work out that big line that's going up. That's Russian bonds. You know, they suddenly moved from, let's say, around 7-8% to around 14-15%. Means the prices have fallen quite a lot in Russian bonds. But they're not alone. Obviously, we've seen Brazilian bonds, Turkish bonds, and even our own bonds take a bit of a hit. Yields move up, so prices fall, so bonds are cheaper. But in South Africa, luckily, remember I've said in previous presentations, South African bonds are cheap. And it's a good thing when your bonds are cheap. It doesn't mean that they won't fall, but they won't fall as much when they move from a cheap price to a very cheap price. So we still think there's opportunities in the South African bond market, but there are risks in nominal bonds that we can't equate at this point because who knows how wars and conflicts plays out. What does it mean for the SARB? Very similar situation than the Fed. I said to you, the Fed may not hike as many times as we all think. Might be very similar for the SARB because remember, this conflict will have an effect on growth. Now, growth is going to be lower this year. Yes, inflation is probably going to be a little bit higher because of the oil price well above 100. Maize prices have just shot through the roof because of what's happened in the Ukraine. Remember, we import a lot of wheat from the Ukraine. So maybe even the SARB doesn't hike that many times this year, right? That's a big change from where we were, that we think the SARB will just keep on hiking. Maybe not anymore. Less rate hikes this year. What does it mean for the nominal curve? So suddenly we said to you the curve is still very steep and it will go flat as the SARB hikes rates. Well, maybe the curve stays a little bit steeper because that front end will be anchored, right? So, but still good opportunities in the South African curve, in that latter part of the curve. Let's say this 5-year to 20-year point of the South African nominal curve stays attractive. Good opportunities for South African investors. Why? Because inflation probably is anchored around 5% in South Africa, but those yields are now up at 10%. Now, nearly 5% real yields on South African bonds. That's attractive for investors. Right, so the asset class that we're really excited about in the South African fixed income space is inflation bonds. Why? Because when you're worried about the rand or currency depreciation or that inflation will be higher than you think, this is the asset class that will protect your savings. Why? Because it's got this inflation accrual element in its metrics. So if inflation goes up, you'll get better returns out of inflation bonds. So if oil stays well above 100, food prices go higher, Eskom gets higher tariffs, well, this is the asset class that will give you good returns. We saw this in 2021 when inflation became a little bit unhinged in the world. Suddenly we had a 15% return from this asset class. So really, this is the one to watch. But if you go into the funds, where do we really sit and where are we positioned? So if you're really worried and you're uncertain about how things play out, you can sit in cash and you can go and sit in the money market fund. It's very exposed to the South African banking system, which is in a good space at this point in time. And we think there are probably returns equal to inflation in this space. But really, this is not a long-term investment. You really just want to sit there until you say, well, maybe the world is a better place and I can actually go and invest in markets. If you're willing to take a little bit of risk, our enhanced yield product range is really out there for investors looking for a little bit extra yield above money market. So let's say that 1.5% above money market funds. You've got a lot more credit risk exposure, but a lot less interest rate exposure. So if you're worried about interest rates going up very quickly, then I think the enhanced yield fund is the place to be. Now let's get more excited. Our best investment view fund, which we call our Momentum Flexible Income Fund, right? This is the team's best investment view. So if we said, look, we have open mandate, where can we invest in the South African fixed income markets? This is how we will be invested. And you can clearly see that we still have an overweight position in South African fixed income, nominal bonds, inflation bonds. But yes, it is an income fund, so there's a floating rate component as well. So if interest rates goes up, there will be a benefit to this fund as well. But we also keep cash. You can see we've got about 10% odd in cash. So if we really see markets sell off and South African bonds really become cheap, or that inflation bonds become cheap, or property becomes very cheap, gives us the opportunity to go into those asset classes and really lock in good returns over the next 2 to 3 years for our clients. Then obviously the one that's a little bit in the gray area at the moment is nominal bonds. Yes, I said to you, nominal bonds are very cheap and we still believe that they will give good returns to clients, but this is obviously where the risk is. If Russia should default, well then nominal bonds will face some pressure, right? So it won't be a domestic event that puts our bonds under pressure. It will be a global geopolitical event. But yes, South African government bonds, the 10 years probably trading around 10%. As we said, inflation is at 5%. So 5% real yields from South African bonds looks attractive in a world with a lot of uncertainty. Then our preferred asset class, as I said to you, where we're really excited about returns is inflation bonds. You can see that more than 60% of our fund is exposed to this asset class. Yes, we do have a little bit of nominal credit in here as well and inflation credit, but we really think that in a world of uncertainty, this is going to be the asset class that really outperforms this year, given that we've seen that oil prices now stay well above 100, that there's a risk to food prices and a risk to growth in the world. We really think that there will be great returns from this asset class over the next year. So how does it play out? We said inflation is going to be 5% this year. Growth is probably going to be not 2% even. So this is not a great environment for growth assets in my mind. So we said, yes, you can go and sit in cash around 5%. Maybe you'll get 5.5%, 6% out of the cash market. you'll probably get 6 to 7% from the credit market if you're willing to take a little bit more credit risk. But we're really more excited around the inflation space, where we think this 8.5%, 9.5% returns is really possible. And then yes, there's a bit of a health warning on South African nominal bonds at this point in time to say that, look, we still think that 7 to 8.5 type returns is possible in this market, but yes, be aware that a Russian default will have an effect on South African nominal bonds, and we have to take that into consideration. But overall, we still think it's a good environment for South African fixed income. But as always, it's good to speak to a financial advisor and get the best view around fixed income allocations. Thank you.